Well, good afternoon. Time to check in on those markets. Coming to you live from the Johannesburg Stock Exchange, where earlier this morning we had banking group Nedbank report its interim figures, declaring an interim dividend that was 81% higher than the comparative period, as well as the pre-COVID levels to mention. But to talk to us about the actual details and provide some color on the half year that was, we are joined by Mike Davies, who is the CFO at Nedbank. Mike, thank you so much for your time. Let's look back at the 6 months that was for Nedbank. How would you characterize your performance, both from, I suppose, financial and operational point of view?
Yeah, I think it's certainly a strong set of financial numbers. If we look across the income statement, we saw strong revenue growth, up 11%. On the expense side, obviously, it maintained cost or expense discipline, therefore translating into effectively a decline in the cost to income ratio to just over 56%. And as you indicate, translating into a dividend up 81%, which I think shareholders will certainly be pleased with. Reflecting on the operational performance, strong operational performance translating into those sort of financial numbers. And I think also important to be able to demonstrate tangible proof points on the execution of our strategy, which certainly we can point to in the first half of 2022.
In your results presentation, you mentioned here you have a retail client that's resilient to date despite rising rates and inflation. What's supporting that resilience?
I think if you go into the beginning part of 2022, obviously our retail clients have de-geared, they've increased savings levels, and that's put them into a reasonably good position going into the start of 2022. And as a result of higher transport costs, higher inflation, and higher interest rates, we are seeing resilience in that retail consumer or client base. But I think things may get tougher in the second half, but certainly clients and that consumer base starts 2022 in a good position.
In an environment that one can, describe as, complex and quite challenging, what are you seeing from a demand for credit, especially when you look at, I suppose, call it, the business, corporates, and especially households as well?
In the household segment, we saw the same momentum we saw in 2021. So that book continued to grow at around 6%. In the corporate segment, we saw very slow growth, certainly in the first quarter and the first part of the second quarter 2022, but we saw stronger growth into the back end of Q2 2022. So certainly corporates starting to grow into the back end of Q2, and we would expect that to continue into half to 2022.
To what extent are you concerned about strain on consumers, especially as inflation continues to rise? We'll possibly see even higher interest rates. You concerned that the consumers might start dipping into those savings and those deposits?
I think we are likely to see that, given higher levels of inflation, which we do expect to peak this month. And obviously higher interest rates. We are expecting a further 75 basis points in the prime interest rate through to the end of 2022. So that is likely to put slightly higher levels of strain on the consumer. But as I indicated to your previous question, the consumer certainly starts in a better position given the levels of de-gearing and higher levels of savings.
From a CapEx point of view, where are you making capital commitments?
So from a CapEx from a lending perspective, it's into the retail segment we've discussed and into the corporate sector as we discussed into the second quarter of 2022. If you're referring to CapEx in terms of where we're spending IT CapEx, we essentially continue to deploy CapEx into our digital strategy supported by managed evolution. So that's as we spend more and more in that technology space to support the digitization of offering to our clients, and we certainly are seeing that translate into materially higher levels of digitization, digitally active clients as they look to engage Nedbank product and service through those channels.
Before I let you go, what will you be focusing on for the next 6 months?
Pretty much being there to support our clients, helping them through in an environment that is likely to be slightly tougher, as we've discussed, and continuing to focus on the execution of our strategy as we move more of our clients into those digital channels and or platforms, and at the back end take costs out as we shift and reshape the operating model.
Mike, let's leave it there. Thank you so much for your time. That is Mike Davis, who is the CFO at Nedbank, giving us his perspective on the first half that was for the lending group. However, as we look at the markets at this particular point, starting off with what we saw on the Asian side, and that was pretty much quite negative, especially as investors digest the inflation figures that came through from China. For instance, when we look at China's producer price index coming in at 4.2% for July, and then when we look at the consumer price index at 2.7%, a little bit slower than some of the expectations that market participants were looking out for. And the reason we're seeing that slower rise when it comes to inflation, at least the underlying inflation drivers, and that's because of the sporadic lockdowns that we had in the Chinese economy, weighing quite heavily on consumer spending as well as business and economic activity. The other key item that markets will be paying attention to is the US inflation figures out at 2:30 South African time, which will be probably the biggest risk driver for the week from a sentiment point of view, especially when it comes to those expectations. But to talk to us about the day, rather the trading day that was so far, we are joined by Tato Mashego, who is from Sanlam Private Wealth. Tato, thank you so much for your time. Let's check in on that JSE, especially looking at the Asian side closing lower because of that, inflation expectations as we look ahead to the US. How are we holding up right now?
Good afternoon, Anastasia. Our market is down 1% so far today, in line with global markets, which are down between 50 basis points and 1% over the day. DM slightly lower than EM. And of course, the US inflation print, probably the most important macro data point for the week, will guide us for the rest of the week in terms of the trajectory as far as the debate on inflation versus potential recession. And at the moment, inflation seems to be top of mind. You did mention, obviously, Chinese CPI at 2.7% and PPI at 0.8% year on year. Obviously very muted. There's no chance of rate hiking in the Chinese economy other than pork prices up over 20% is a sign of weak economic data at the moment and trajectory in the Chinese market. And Asia has been weak, as you pointed out, and fears of continued reversal and strengthening in the dollar and weakening of Asian currencies and EM currencies in general, with potential rate hike schedules for September and November of potentially 75 basis points in both of those upcoming Fed meetings. So a lot of concerns at the moment. The market is pricing in a 75 basis point hike if we look at the Fed funds rate futures, and perhaps consensus is being a bit too optimistic with the 8.7% CPI print which they're expecting.
Yeah. So a little bit earlier, we had Mike Davis, CFO at Nedbank, talking about the company's interim figures. Were there any key highlights for you when you look at the bank's performance?
The bank has performed well. Year-to-date retail deposit growth of 3.6% has been ahead of its peers within the Big Four. So advances growth has been quite particularly impressive in that regard. On the corporate side, not so much. Overall, we saw strong net interest income growth, I think about 7%, coupled with very strong performance on non-interest revenues, up 13%, and part of that that had to do with fees and commissions, obviously due to quite volatile markets during the period. ROE, I believe around 13.5%, still below their medium-term target of 15 and longer-term target of 18%, but they do have levers to pull to improve that. At the moment, their CET1 ratio is still quite high at over 13%. They want that to come down to 11 to 12%. So, of course, there is capital which they could redeploy via increased dividends. For a period, dividends were up about 80%. They could also obviously reallocate that to further advances growth. So they do have levers to pull to improve on the ROE, as well as net interest margins through further cost controls. But so far, a quite strong performance from the top line in terms of retail advances growth, as well as potential further cost improvements and net interest margin improvements. Obviously, they mentioned that there are some headwinds in the local economy due to electricity and some other factors which will be of concern looking in the second half of the year.
Over the next few weeks, we're going to see quite a lot of the JSE listed companies reporting their earnings. Is there anything in particular that you're going to be keeping eye out for, especially with, I suppose, call it outlook or certain line items in those financial statements as those different companies report? What will you be focusing on?
Given the current environment where inflation is a significant concern, and I think especially for Q3 this year, one will have a look at how various sectors and companies are able or unable to pass through inflation. So top line in terms of growth year over year in constant terms, is one of the, I suppose, measures, as you know, in terms of relative to inflation that market participants will be looking at, as well as GP margins, just to see how much pressure from a cost perspective and supply chain perspective the relative sectors are facing at the moment. And then various other sector-specific measures, just to get a sense of how well these companies and sectors are trading in the current environment. So certain sectors which may or the market may assume are better able to protect their earnings against inflation, such as consumer staples, utilities, telecoms, will be expected to do so. Other companies and sectors where one would expect trading down, so for instance in the retail space, certain companies that target lower income consumers may benefit at the expense of those focused more on the mid to higher end. So there's various factors and points of consideration that market participants will be looking for in the next or the upcoming results season.
Just curious, how fragile or vulnerable is this market to data that might entail more than disappointing inflation figures or even higher interest rates?
I would say significantly fragile at the moment. If we consider one discussion around the US economy, whether or not it's in recession, every data point or new data point that comes in adds credence either for or against that argument. And we'll only know, I suppose, exposed or after the fact in 3 to 6 months' time. But at the moment, all data points are helping to build or perhaps destroy certain investment views or cases. Point in case, we had data on US oil inventories build up that came out, where last week 2.2 million barrels of oil were added to strategic stockpiles, whereas consensus was expecting only 100,000 barrels. So that's a significant divergence, and that led to oil prices declining now at about $95 per barrel. And especially on the inflation front, because of course we know that the US economy, at least from a jobs perspective, with the numbers that came out last week Friday, is looking quite positive. Unemployment declining down to 3.5%, and this gives the Fed room to push through further rate hikes without the risk of causing a recession. And so the question, of course, is: are we going to see 2 additional 75 basis points hikes in the next 2 meetings, or will that moderate to 50 basis points hikes, or perhaps even increase to 100 basis points hike in the first meeting? And the print that will be coming out later today on US CPI will go a large way to determining that outcome. So I think the market is very fragile as far as certain macroeconomic data that is coming out, and it will frame many other aspects as far as yield curves, interest rates, as well as capital market prices on the bond and equity side over the next few weeks.
Tato, thank you so much for your time. That is Tato Mashego, who's a portfolio manager at Sanlam Private Wealth, giving us his perspective on the markets and also throwing forward to what we can expect for that 2:30 p.m. CPI figure from the US. That is it from me. We're going to take a break and we'll have more news for you, so stay tuned.